This hearing, which is basically looking at the IPO process, what is your aim exactly? What do you hope to get out of this hearing?
Well, first, the IPO process is very important to form capital for growth companies so they can expand, but we also have to ensure that investors have a fair shake. And so what we're trying to look at is not only the ability to raise capital by small companies going public, but also that investors are fairly protected.
But is your premise that the Jobs Act that was passed in March disadvantageous to retail small mom and pop investors? Is that your premise as you go into this hearing?
I think there's a strong sense that I have that the Jobs Act was not well drafted, that there's a potential, for example, to essentially waive protections for consumers like audited financial reports, detailed information that might not in fact increase IPOs but will disadvantage consumers, investors, retail investors particularly. So I was one of a handful that opposed the act. I just don't think it's solving the problem.
Are you looking to repeal it or water it down?
Well, to be very practical, to repeal it would be very, very difficult. But two, what we tried to do by amendment was to limit its impact by reducing the thresholds. Right now, an emerging growth company can have revenues up to $1 billion. A company that can generate revenues of $1 billion certainly should be able to comply with audit standards, should be able to comply with better disclosure. So that's one of the major criticisms, but that'll have to resolve going forward. It can't be fixed immediately.
Senator, what about the role of analysts? The Jobs Act lets analysts actually do part of the sales job of IPOs, and for big companies and big IPOs, it's not a big deal, but for the bucket shops and the crummy IPOs out there, that has historically been a real problem.
It has been a problem, Corey. As you know, there was a settlement basically when it was revealed that analysts were really sort of being promoters, not analysts. And, their objectivity was questioned. There was a legal settlement that barred them, and this legislation essentially undid that legal settlement. So now you have a potential for someone who, particularly a retail investor, feels is objective, is not objective at all. They're perhaps sharing directly, indirectly in the offering. That, I think, is a potential for real significant problems.
I also wonder if you've got a concern and want to try to, there's a fundamental principle in securities law about the accredited investor that basically says that rich guys have a right to do more risky things with their money. They can participate in hedge funds. They can be part of, issues with the Facebook IPO where they may have got information about the deal that the rest of the retail investors didn't have. Do you have a problem, and do you intend to try to undo the rights, if you will, of the accredited investors?
Well, the accredited investors are those individuals that can participate in private offering because they have a certain financial wealth or demonstrated sophistication. Sometimes there's a question about that. But our intent is really to look at the public offering process where there is eventually some type of filing with the SEC and it's open to retail investors. But there's a problem there, too, about access to information. In the book building that the promoters of these IPOs do, there is sometimes access to sophisticated information that the analysts get, that the big investors get, but the retail investors don't get. And I think we are looking seriously at how that information could be more broadly shared.
Senator, while I have you here, I just have to ask you about last week's hearing with Jamie Dimon, because you were a member of the Senate Banking Committee, and you had questioned Jamie Dimon. Now that he's wrapped up the hearings on the Hill, are you convinced that that London whale trade was in fact an isolated incident at JP Morgan and that the bank is not too big to manage?
Well, there are still serious questions about the ability of large institutions to manage some of these investments. JP Morgan is a very sophisticated financial institution, and yet Mr. Dimon conceded that he's indefensible, in his words, this trade. It looked not like a hedge against the risk the bank was taking. It looked like a speculation. And part of what we've tried to do in Dodd-Frank and the Volcker rule is to limit hedging by federally insured depository institutions to simply protecting their clients' investments, not speculation for the bank's benefit. So I think there's still a lot of questions. The OCC is the primary regulator, but they've got to come up with real answers.